This part 2 video of Medicare Supplement Hidden Risks was very difficult to put together. The reason is that although I know what I want to say, I also know that I need to show you. So I apologize if this video starts out a little slow, but by looking back at what I predicted in August of 2019 and how those warnings have come to fruition, you'll better understand and have confidence in what I suggest you do for now and in the future. So no one has shown this kind of stuff before, so this will surprise you. By the end of this video, you will have a checklist that you can use to filter out companies that have a higher level of hidden risks. Now, what do I mean by a higher level of hidden risks? The reason we get insurance, any insurance, whether for a car, a home, or your health, is to take the financial risk of an event and move it onto that of an insurance company. It's to transfer risk. Unfortunately, with Medicare, selecting the wrong insurance company can introduce other risks that you're not even aware of. And these are the hidden risks. To refresh the premise that I stated in the Hidden Risk Part 1 video, the insurance company you choose will have a greater impact on your price over time than which supplement plan you choose. It's not just whether or not you choose a Plan G or a Plan N and so on, it's which insurance company that you use. By using the checklist that you'll see in this video, you can simply avoid many of those hidden risks. And again, as I stressed in the Part 1 video, finding the right insurance company is not about finding the perfect insurance company. There is no such perfect insurance company. It's not about finding a company that will never raise prices. That doesn't exist either. It's about setting rules, setting a minimum standard by which you filter out the companies most likely to have these hidden risks that I'll be discussing. After you have filtered out the poor choices, you'll want to have a process for managing the other risks. Those are the risks that cannot be avoided. We're going to talk about that in detail as well. If we haven't met yet, I'm Matthew Clausen, CEO of MedigapSeminars.org. We're one of the premier independent insurance brokerages in the country specializing in Medicare. Our services are free to you, the consumer, because like all insurance, we're paid by the insurance companies when we help people with their insurance applications. Our goal is to help you make an informed decision regarding your Medicare. So please contact us today to help with your Medicare. You'll be glad you did. Okay, let's set the stage for what will be item number 1 on your checklist. And again, I apologize if this video starts out a little slow, but bear with me, this is going to be eye-opening. I believe it was back in 2015 when the Medicare supplement market got all in a frenzy of excitement because CSI, Central States Indemnity, a Berkshire Hathaway subsidiary, started selling Medicare supplement plans. Berkshire Hathaway, if you don't know, is the great Warren Buffett's company. So agents were selling CSI Medicare supplement plans saying that it'll be a great experience because you're partnering with Warren Buffett. Warren Buffett is managing your Medicare, and so on. I like Warren Buffett. I think he's awesome. But something bothered me. My background in finance had my spider senses tingling as I noticed something odd in the Berkshire Hathaway annual report, and I'll show you that in just a second. So I stayed away. I didn't offer their supplement plans, even though they were very competitively priced. I'm sure I lost business to those who just wanted a cheap supplement plan. Then in 2018, CSI started to sell off its Medicare supplement business to a company called CSO, Central States Health and Life of Omaha. Both, by the way, were Omaha, Nebraska-based companies. CSO was originally in the Medicare supplement market in the early 2000s. And after about 4 or 5 years, they sold their Medicare business to Berkshire Hathaway. And then here, about 10 or 10 plus years later, they were buying back some of the business back from Berkshire Hathaway. So CSI sold its Medicare existing business in about half of the states in the country to CSO. When I made my original Hidden Risk video in August of 2019, CSI was still offering Medicare supplement plans to the public in half the country, with no indication to the public that that would ever change. And if you didn't know, Berkshire Hathaway also owns Geico. So in my original Hidden Risk video from 2019, I said this. It appears to me that Berkshire Hathaway still doesn't intend to be in the Medicare supplement business over the long run. My opinion. I don't believe that they will be. And one of the tells, again, is just to look at the Berkshire Hathaway annual report. In the last annual report for Berkshire Hathaway, they indicated that the CSI had 47 employees. Now that's a far cry from Geico's 40,000 employees, and it means that they're outsourcing the servicing of the Medicare supplement plans. When an insurance company intends on being in the market in an area for a long time, they don't typically outsource the servicing of that business. So that was August 2019. By July of 2020, if you went to research CSI and Medicare, you got this. It reads, effective July 1, 2020, we discontinued issuing Medicare supplement insurance policies, period. So within a year of my original Hidden Risk video, CSI had exited all of their Medicare supplement plans. They sold the remaining portion of the Medicare supplement business to CSO. If you had a CSI policy, you were in a closed pool managed by CSO. Because these policies were still actively managed, if you wanted to get a new policy, you'd be required to qualify medically through underwriting. Now, when I was making this video, I also noticed that there were no CSO Medicare supplements anywhere. I could still find their website. Looks like this. But I'd not thought about the company for a long time, so I didn't even notice that it wasn't showing up on the quote engine anywhere. So then I found this. Effective December 31st, 2020, Central States of Omaha CSO has discontinued new sales of Medicare supplement policies in all states. Ouch. Now, I can't find exactly what they did with the existing policies, but it appears they still exist and they're still managed by CSO as a closed pool, which means CSO still reaps the cash flow from these supplement plan premiums, and also means the policyholders have no guarantee issue right to get a policy with a different company. As an aside, I can hear the comments already. Well, I'm in a birthday rule state, so I doubt I don't have to worry about this. Several states added an annual open enrollment called the birthday rule for supplements in just the past year. I will probably make that a subject of a separate video, but let me assure you the unintended consequences will force many more people out of Medicare supplements in those states in the years ahead, as it has already in the states that were where that concept had originated. If insurance companies are forced to offer health care without considering your medical history, they simply raise prices, and then everyone pays much, much more. So cheering a birthday rule is like cheering that your friend got sick and you get to pay the medical bills. But again, that's a subject for a future video. Back to this video. But first, please do me a favor and press the like button. If you find this information unique and helpful, please share the video and let me know in the comments section what part you like best. So thank you for that in advance. Now, CSI and CSO were two big A or A+ rated insurance companies that started and dropped Medicare. The only people hurt were the policyholders, who either must be healthy enough to change plans or endure the price increases. Is this a one-off situation? Sadly, no. This happens on a regular basis with both supplement plans and advantage plans. For example, in that 2019 video, I also talked about LCBI, Loyal Christian Benefit Association, who stopped selling Medicare supplement plans in 2019, the same way as CSI and CSO did later. So here is the rule that I want you to write down as rule number 1 on your checklist, and then I'm going to share with you what's going on and why this will continue. Rule number 1, avoid all companies that have not been selling Medicare supplement plans for at least 5 years. It doesn't matter if they have a parent company that's been in the business for generations, or if they're reinsured or backed by an industry titan like Mutual of Omaha. which many of the new to Medicare companies are. Now, why? Why is this happening, and what exactly is happening? There's a lot of money in Medicare, a lot. Often, venture capitalists from outside sources will fund a new venture into the Medicare market, expecting a huge 5-year return. They often hope to liquidate their investment capital in about a 5-year window and, of course, realize their gains. Sometimes, instead of venture capitalism, these expansions into the Medicare is funded by a parent insurance company for the same reason. They are not and do not expect to be in the Medicare business for the long run. Often, their intent is to create a base of policyholders and then sell that base for a profit. A second thing that happens, as with the case of Loyal Christian Benefit, is the company simply can't get from start to profitability fast enough. They must stop selling because they don't have the base of clientele that's required to be successful. This also happens with Medicare Advantage plans. As I mentioned, I believe more often than with supplements. For example, we see every year some doctor or hospital group trying to create their own Advantage plan and then close them down within just a couple years. Or there are cases like this example. A company called Lasso had a great Medicare Advantage plan called a Medicare Savings Account, or MSA. And I'd been watching it because I liked it, and once it got past the 5-year mark, I would offer it to those who choose an Advantage plan. Well, 2024 was supposed to be year number 5, so I went to contract with them and I found this. Lasso Health Insurance Company has made the difficult decision to discontinue Lasso Growth MSA and Lasso Growth Plus MSA at the end of the year. Coverage will continue through December 31st, 2023. But don't worry, they started a brand new Medicare supplement company this year. They're not giving up. We'll see if they're around in 5 years or at what price. So what I'm seeing a lot of now that drives me to put this as rule number 1 on your checklist. There is an astounding number of new Medicare companies getting involved in Medicare supplement plans just in the past 2 years, more than I've seen since supplement plans were modernized back in 2010. Some have the backing of an existing insurance company. Many have the backing of a property and casualty insurance company. And that seems to be a new trend. So property and casualty, P&C, is insurance for your car, your home, your boat, your store, or your office. Many of these companies are closing their P&C business in certain areas because of the unpunished theft and vandalism that is out of control. So they are dipping their toes into Medicare to make up for P&C losses. If you don't filter these companies out, you run the risk of either aligning yourself with a company that is simply using you as a means to flip the business for profit in 4 or 5 years down the road, or you're a guinea pig as they find out if they can or can't run a Medicare supplement program. As an aside, when an insurance company buys out or merges with an existing Medicare supplement insurance company, now that doesn't count as new in my book when talking about being in Medicare supplement for at least 5 years. So case in point would be when Allstate bought National General. National General had been offering Medicare supplement plans for decades. As long as they kept the same team of managers, they're not new. Now, one other example that if you watched part 1 of Hidden Risks, I know that you'll like this. In my 2019 video, I mentioned avoiding a new company and said this. As you're listening and watching this video right now, there are at least a dozen companies out there that are a mixture of the 2 examples that I just noted. There's a company I know that's a subsidiary of a large Swiss insurer. They started offering Medicare supplement plans in 2017, and their business is small. In fact, without naming names or blowing horns, I know of individual insurance agencies that do more business than this insurance company. But you, the consumer, wouldn't know that by their beautiful and professional website. Who is this company backed by a large Swiss insurer? The company is Lumico. Back in 2019, when I made that video, they were all over the country and one of the lowest price supplement plans available everywhere. They're backed by Swiss Re. It's a huge company. Again, I'm sure we were losing business by not recommending them to those who are just looking for a low-price plan. Currently, Lumico is in very, very few states. They're tough to find, but everywhere I did find them, their prices are among the most expensive supplements available, and their website's not very fancy anymore. So what does this tell you? Even if the new kid on the block doesn't go out of business or sell their business in 5 years, they could be managed in such a way that they become a very expensive mistake. And this relates to rule number 2. Rule number 2 is really detailed in the Hidden Risk Part 1 video. It is avoid the unknown or not nationally known companies that are selling the cheapest supplement plans in the age 65 to 68 age bracket. So see part 1 of the Hidden Risk video if you haven't already, where I detail how the cheapest plans can become the most expensive. Now rule number 3. Rule number 3 has to do with ratings. Now there are 2 groups of ratings that insurance companies have. The most commonly known is the AM Best ratings. That rating gives you an idea of the confidence that you should have in the insurance company's claims paying ability. That's nice, but if a Medicare supplement plan can't pay their claims, you get a guaranteed issue option to a new insurance company. You are never liable for the supplement or Medicare's portion of the bill. The second rating, if they have it, is the Standard & Poor's, the S&P rating, or Fitch or Weiss. This is important because it shows their bond ratings, which directly impacts the costs of raising funds for growth and expansion and so on. So here it is. Rule number 3, avoid companies with a lower than an A- rating with AM Best. And if they have an S&P or Fitch or Weiss rating, then at least an investment grade, which is BBB- at a minimum. If they don't have an AM Best rating, avoid them. Small to mid-sized companies with lower ratings are most likely to benefit from being the subject of a buyout. These are the companies that are more often targeted, and they could be easily absorbed by a larger company, which will negatively impact your supplement plan price over time. And I've seen these cases where Medicare supplement sales were just a small portion of a company's business. And the insurance company was bought out because the buyer wanted their life insurance or their annuity business. And the supplements are then closed, managed, but closed to new business. So on this subject alone, I can spend a half hour, but this is already a long video. Please check the ratings, avoid low-rated companies with no AM Best rating. This is important. If the company is a subsidiary of a larger organization, it's the parent company's ratings that are the ratings of the smaller company. That's important to understand. So before I move on to rule number 4, I want to know what you think of this video so far. Like I said, this was a tough one to put together, and I hope I haven't bored you to sleep, which is really my biggest concern. But if you've learned something from this video, please share it, press the like button, comment below. Let me know what information in this video got to you the most. Also, please subscribe if you haven't already. And all right, rule number 4, avoid regional companies. I know I'm going to get into a lot of unfriendly feedback on this, I know, but go ahead and shoot it at me when you're ready. Did you know that there's no big or national Blue Cross Blue Shield insurance company? Blue Cross Blue Shield is an association whose members pay to use their name. There are 34 different companies that call themselves Blue Cross Blue Shield. They're different companies, completely independent of each other. Different people, different home office, different corporate makeup, different ratings, different everything. They simply pay the Blue Cross Blue Shield Association money to use their name and logo and such, so that they look bigger than they are. And of course, the association provides them information and guidance. I don't think it's a turnkey system, but it helps. Many of these companies only do business in one state, like Blue Cross Blue Shield of Alabama or Arizona or Connecticut, or Colorado, California, Florida Blue, and so on. The largest of these companies is Anthem, which I think recently changed its name to Elevance. and is in 14 states, which is larger than the definition of regional, which I'm referring. Other than Blue Cross Blue Shield, the companies that I refer to are usually active in only 1, 2, or maybe 3 states. The simple fact is that they, as a rule, tend to have higher price volatility and again be targets of buyouts for insurance companies that want to increase their exposure in whatever state they're in. There's one more rule that I use that's really a guide, not a rule. Still, it's something that you should know. If you don't know this, you should. There are 3 different ways a Medicare supplement plan can be priced. Each has positive elements and negative elements that you should be aware of. Now, because this is already going to be a long video, I will discuss Medicare supplement pricing methods in the next video. As far as the 4 rules we've covered in this video, these are rules we use in my office. This is why we don't and won't offer every insurance company. The rules so far are: rule number 1, avoid all companies that have not been selling Medicare supplement plans for at least 5 years. Rule number 2, avoid the unknown or not nationally known companies that are selling the cheapest supplements in the age 65 to 68 range. Rule number 3, avoid companies with lower than an A- rating with AM Best or no AM Best rating, and if they have an S&P or Fitch or Weiss rating, then at least an investment grade, which is BBB- and better. And number 4, avoid regional companies. Using these 4 rules to filter out the insurance companies will help you avoid these hidden risks. But there are other risks. There are events that are simply not predictable. How are you going to manage them? The decision you must make as you decide what to do with your Medicare is basic. Do you want to depend on just yourself to know as much about Medicare and insurance companies as someone like me? Or do you want to hire me and my team to help you navigate all the things that can happen with your Medicare in the years ahead? One of the great advantages of working with an independent Medicare specialist like Medigap Seminars is that when something goes wrong, we have the knowledge and the experience to guide you through it and can access a solution from any insurance company out there. Best of all, like any other insurance agency, you don't pay us. We're paid by the insurance company when we help you with an application. There's no reason to try to manage all of this yourself. So call us, send us an email, let us help you make an informed decision. So have you pressed the like button below yet? Have you subscribed so you won't be missing out on any of my future videos? Now's your chance if you forgot. I'm Matthew Clausen with MedigapSeminars.org. Thank you for watching.